Paychex just dropped their Q1 fiscal 2026 numbers. Big headline, 17% total revenue growth.
Yeah, strong top line.
And maybe more importantly, they've raised their full-year adjusted EPS outlook. So let's dive right into that.
Absolutely. It's definitely a report with some, let's say, interesting layers. On the surface, things look good. Total revenue hit $1.54 billion for the quarter ending August 31st.
That's the 17% year-over-year growth you mentioned, right on target.
Exactly. And the number everyone watches, adjusted diluted earnings per share, that came in at $1.22. That actually beat the $1.20 forecast. So 5% growth there year over year. Profitability looks, a bit ahead of schedule.
Okay, and this is the crucial bit for you listening, that's the adjusted number. If you just look at the standard accounting, the GAAP numbers, it's a very different story, isn't it?
It really is. GAAP diluted EPS down 10% year over year, and GAAP operating income actually fell 1% to about $542 million.
So a beat on adjusted, but a miss, or rather a drop on GAAP. What gives? Why the big gap?
It boils down almost entirely to one thing. The Paycor acquisition costs. They're still working through integrating that massive purchase.
Right. The integration expenses. So temporary costs hitting the books now.
Precisely. Buying a big company comes with big, often non-cash accounting charges.
Yeah.
In Q1, Paychex had $84.8 million in costs specifically tied to the Paycor deal hitting their GAAP results.
$85 million. Wow. What's in that?
The biggest piece, about $61 million, is amortization of intangible assets. Think customer lists, the software platforms they acquired. It's a required accounting expense, but it's not cash going out the door day to day to run the actual business.
Okay, so it makes the official GAAP number look worse, but doesn't reflect the underlying operational health. Is that the right way for people to think about it?
That's exactly it. Once you pull out those acquisition-related costs, the amortization, some integration and compensation expenses, you get to the adjusted operating income. And that number grew a very healthy 15%, hitting almost $627 million.
15% growth. Okay, that feels much more aligned with the 17% revenue growth. That's the core business strength shining through that.
That's the argument, yes. That 15% is what management points to as the real measure of how the combined Paychex and Paycor operations are performing right now.
Makes sense. So let's talk about where that 17% revenue growth actually came from. Which parts of the business fired on all cylinders?
Well, it was overwhelmingly driven by their main segment, Management Solutions. That's the core payroll and HR services unit. It's up 21% to $1.2 billion. Just a powerhouse quarter for MS.
21%. But I assume Paycor played a pretty big role there.
Oh, absolutely massive. You really can't separate the two this quarter. The Paycor acquisition itself contributed about 17 percentage points of that 21% growth in Management Solutions.
So almost all of it was the acquisition adding revenue.
Pretty much, in terms of the year-over-year comparison lift, the rest came from, growth in their existing client base, more worksite employees needing HR solutions, price increases, and selling more services like HR and retirement products to existing clients. And crucially, Paycor brought in clients who tend to be a bit larger, more upmarket.
Right, which helps boost the average revenue per client. They mentioned cross-selling success there, too.
Definitely. That higher revenue per client was a key factor, driven by that upmarket base and getting those new Paycor clients onto Paychex platforms and services. Early signs of revenue synergy.
Okay, so Management Solutions is booming, largely thanks to Paycor. But then there's the other side of the coin, PEO and Insurance Solutions. That segment looks, well, much slower.
Yeah. That's the contrast. PEO and insurance only grew 3% year over year to about $329 million, a stark difference from the 21% in MS.
3%. And yet they're still guiding for much higher growth for the full year in that segment, right?
They are. They reaffirmed the full year guidance for PEO and insurance solutions at 6% to 8% growth.
Okay, so they did 3% in Q1, but they need to average significantly higher, maybe double that pace, for the next 3 quarters to hit the midpoint of 7%. How do they justify that? Is that confidence or hope?
Well, they argued the underlying demand is actually quite strong. They pointed to record worksite employee retention in the PEO, double-digit bookings growth, which led to mid-single-digit growth in the actual number of worksite employees they managed.
Thus, more employees signed up, but the revenue didn't follow at the same pace? Why not?
They called out specific at-risk plan headwinds. It seems mostly related to their insurance offerings, especially in Florida, which is a very competitive market. They also mentioned pressure from workers' compensation rates impacting their agency business.
At-risk plan headwinds. So does that basically mean they maybe walked away from some less profitable insurance business or had to adjust pricing in a way that hurt revenue in the short term, even if the client numbers grew?
That seems to be the implication, yes. Prioritizing risk management and maybe underwriting quality over just chasing top-line growth in certain insurance areas this quarter. It suppressed the Q1 revenue number, even though the underlying client base grew.
Got it. Protecting margins, perhaps, even at the cost of Q1 revenue.
Oh.
Okay, that sets up the acceleration argument later.
Yeah.
Before we get to the guidance update overall, there was that third, smaller revenue piece, interest income.
Right. Interest on funds held for clients, that jumped 27% to nearly $48 million.
Also Paycor related.
Entirely, according to them. Just having the larger pool of client funds from the Paycor acquisition boosted the average investment balances, leading directly to that higher interest income. The M&A impact is really everywhere in these results.
Okay, so despite the drag from PEO growth in Q1 and those big gap integration costs, Paychex still felt confident enough to raise their outlook for the year. That's the headline move, right?
That's the key update, yes. They specifically raised the expectation for adjusted diluted EPS growth. The new range is 9% to 11% growth for the full fiscal year. That's up from their prior guidance of 8.5% to 10.5%.
So they see profitability improving faster than they initially thought. Why now?
It seems to come down to execution and confidence in the Paycor integration. Management basically said the strong Q1 results, despite the PEO headwinds, showed they are realizing both cost and revenue synergies maybe a bit faster or more effectively than planned. They're on track for their cost synergy target, which is about $90 million this fiscal year.
And the rest of the guidance held firm. No changes to the revenue targets.
Correct. Total revenue growth guidance remains 16.5% to 18.5%. Management Solutions stays at 20% to 22%. And as we discussed, PEO and Insurance Solutions growth is still pegged at 6% to 8%, implying that acceleration later in the year. Adjusted operating margin guidance also held steady around 43%.
Let's dig into that synergy confidence a bit more. The CEO's comments suggest the cross-selling piece especially is working really well.
Yeah, they sound quite bullish there. They talked about building a strong pipeline, specifically targeting those, 50,000 Paycor clients, offering them Paychex's retirement services, the PEO offering, and their ASO, which is Administrative Services Organization.
And wasn't there a specific example they gave about moving up market? That sounded pretty significant.
There was. They mentioned landing an ASO deal with a former Paycor client that has several thousand employees. They flagged it as one of the largest ASO sales in Paychex history.
Wow. Several thousand employees. That's a big win.
It is, and it really supports their argument that the Paycor acquisition isn't just about adding volume, it's about gaining access to larger, more complex clients who are ready for Paychex's higher value, often higher margin services. It suggests the upmarket push via M&A is bearing fruit quickly.
And it's not just about sales teams hitting the phones, right? They're also investing in tech to make the combined offering better. Talked about AI quite a bit.
They did. It's clearly a strategic focus. They've expanded their generative AI tool called AI Insights to their PEO clients now.
What does that actually do for a PEO client?
Basically, it lets them ask complex HR questions in plain English things about pay equity trends, turnover analysis, labor cost breakdowns, and get instant answers and insights. Data that might have taken an HR manager hours to pull together manually.
That sounds genuinely useful.
And they're using AI internally, too. They have an AI tool helping their own HR support staff, trained on millions of past client interactions, to help them give faster, more accurate guidance. So efficiency gains for them, better service for the client.
Beyond the AI buzz, they also added a partnership, didn't they? Something about payments.
Yes, they launched a bill pay solution, which is powered by Bill.com. The idea is to integrate accounts payable functions directly with the payroll and HR platform.
Making life simpler for small businesses, presumably.
That's the goal. Bundle, payroll, HR, and now bill payments all in one place. It adds stickiness to their platform, makes it harder for a client to leave, important in the competitive HCM market.
And just stepping back, what's their take on the overall economy for their main customer base, the small and mid-sized businesses?
The CEO described the SMB market as remaining resilient. They see employment holding steady, and wage inflation pressures seem to be easing a bit. Their view is that as things become clearer on big picture issues like taxes, interest rates, businesses might feel more confident to start investing and hiring again. Less uncertainty.
Okay, let's loop back to that PEO growth acceleration we talked about. They did 3% in Q1. Needs 6% to 8% for the year. You mentioned the at-risk plan headwinds. How exactly do they get from 3% to potentially 8% or more in the later quarters?
The key is the comparison period. They're banking on the second half of fiscal 2026. Those at-risk plan headwinds and some lower enrollment rates apparently hit them harder in the second half of last fiscal year.
So the year-over-year comparisons just get much easier.
Exactly. As they anniversary those tougher periods, the underlying growth they're seeing now, the good retention, the double-digit bookings, the mid-single-digit worksite employee growth, that should translate into much stronger reported revenue growth in H2, assuming those specific headwinds don't reappear with the same intensity. Easier comps plus solid underlying growth equals acceleration. That's the math.
Right. So if you had to boil down this whole Q1 report for our listeners, what's the single biggest takeaway?
I think the core story is really about the Paycor integration. Paychex delivered strong overall growth, yes, but it was overwhelmingly powered by adding Paycor. They took the expected hit on GAAP earnings because of the necessary acquisition
The
costs.
price of admission, as you said.
Right. But the key is they're already seeing enough synergy benefits, both cost and revenue, to feel confident raising their adjusted profit outlook for the whole year. It really looks like a case study in executing a large, complex merger effectively, maybe even ahead of schedule.
And that point about the cross-selling, especially that huge ASO deal with a multi-thousand employee client, that does feel significant beyond just paychecks. Given how well they seem to be monetizing these acquired larger clients, what does that suggest about the future of the whole human capital management software space?
That's the provocative question, isn't it?
Are we seeing proof that large-scale consolidation can actually unlock significant cross-selling into more premium services? Is this the start of a bigger trend where scale allows for much deeper, more profitable client relationships across the HCM industry?
Paychex's Q1 certainly gives us something to think about there.